Well, it's a good morning from me and it's a good morning from him. That was on the two Ronnies. That was a long time ago. That was. If anybody's showing their age there, I probably am as well. Good morning and welcome to my mortgage live stream. Hope everybody's well. We're live, I guess, I don't know, all over the place probably. We're YouTubing, we're Facebooking, and we are Vimeoing and LinkedIning as well, if that's the right word to use. Welcome. So let's get online. So let's get on there. Had a lovely weekend, Shelley. I went down to Devon, North Devon, a place called Appledore. Had a lovely weekend. Good weather, lots of walks, gets you fresh, doesn't it? Gets you raring to go. But I took a bit of reading matter down with me, as I always do, because that's the way I roll. And a very interesting article there on stagflation, which I'm going to be talking about this evening when we do our live drop-ins. And I'm going to write about it tonight, by the way, stagflation. It's the way it's going in the next few years. It's quite new. It's not happened since 1973. And it's kind of like a lot of knock-on effects from some oil prices, of course, the Ukraine war and all those things. Although I'm not allowed to say war, am I? Because the Russians are going to be after me. But there we are. I don't mind because it is. Enough of that. Let's get into some more important topics, i.e. mortgages and CMAPs and all sorts of things. Lots going in the mortgage world, of course. Still a lack of sellers on the market, which of course is making house prices rise. I read at the weekend the average house price has now exceeded, was it 350? Ridiculous figures, really think about it. So I do feel first-time buyers, which actually launches me then onto our first topic, which is talking about first-time buyers. And as you know, if you've listened to my podcast and all of my kind of videos on YouTube and things, I've talked about this big change this year when the Bank of England and the PRA, the Prudential Regulatory people, got together to look, this stress testing we bought in 8 years ago was a bit knee-jerky reaction from the financial crash. So let's get rid of it. And that way we can let lenders lend more to people, particularly first-time buyers who need to be able to borrow more because rent is so blooming expensive. And this hit home to me actually over the last couple of weeks. My two boys, Ewan and Lewis, I don't know if they listen to the podcast. I'm sure they don't. Their old dad doing that, but they're 27 and 25 respectively, and they're looking to get a place together. Now they live at home with their mum, which is fine, but they need to get a place. So we talked about buying and we talked about renting. They're going over to renting, which is totally fine because they need to stretch out and see what life's like outside of the family home. And it's very expensive to rent. It's very pricey. And of course, each year, landlords put up rent by the RPI, by inflation, which of course is ravaging at the moment. So it's very expensive. Now, over the weekend, I talked to them about mortgages again because we're starting now to see a few lenders coming through with this stress testing going. They've obviously been talking to their PRA, because these are lenders, of course, who are authorized via the PRA, about how they can lend a bit more to people. And one came to mind, which is the Nationwide. Now, I like the Nationwide. I used to work for them years ago when they were a smaller building society back in the 80s, long time ago. I like the Nationwide, I like the style, I like their principles and morals. And they've introduced this thing called a helping hand mortgage. And just want to highlight it to you. You probably know about it if you're in the broking world, but if you're learning and doing CMAP, you may not know about this sort of thing. So first of all, let's head over to the website, because what I want to do is share with you the website. So let's just change the view on the screen. Those of you listening to the podcast, of course, can't see the screen, but there we go. I've zoomed into the Nationwide's consumer website. Now, this is for consumers. It's not for brokers. And it's called the Helping Hand Mortgage. And the great thing about it is they will lend you loads of money. They'll do it up to 95%, as you can see. So let's just highlight that for you. They'll do it up to 95%. There you go. So you can see that. So 5% is all you need. But so they give an example there, the kind of money. So somebody on a joint income of 55,000 can borrow up to 5.5 times their salary. So you could end up borrowing about £300,000 if you're on a joint income of 55. Now, that's really good. That's really, really good. And they advise you to take out a 5 or 10 year fixed rate mortgage, as you can see, to keep the costs budgetable. They say 5.5 times your income with a 5% deposit. Now, in my opinion, that's a game changer for first-time buyers. Features and benefits, all the usual things. There's even £500 cash back there, which is great. What they don't do, though, is they don't do self-employed, and they don't do affordable home schemes, and it's not for new homes either, the 95%. It's for second-hand homes. So there are a lot of caveats and things. It's quite clever, really, because they're looking for clean as whistle mortgages. If maybe I've just invented a phrase there, clean as whistle mortgages, but they're not looking for self-employed or anybody with a bit of a dent on their credit history or anything like that. So it really is smart lending as far as I'm concerned. Now, a couple of things come to mind here. Number one, it does show you that first-time buyers now, if they're employed, one person, two people maybe, can borrow some good money. So Lewis and Ewan, for example, I worked out the numbers. I think they're on about 50,000 jointly, the two of them, not a huge amount, but together they're earning a bit of money. They could borrow up to about 300, something like that, with a little bit of a deposit. They could look to getting a two-bedroom property in certain parts of Gloucestershire, and why not? But they'll rent first and get used to living together, then they'll buy. It's great. But what's the canny little situation here is that if I go back to the website for you, you can see it. That's the Nationwide's consumer website, which is for consumers. They've got this thing here, a first-time buyer event. Isn't that quite clever? On the 24th of May 2020, we're hosting a free online event for first-time buyers online. Just register and you'll get to speak to Nationwide people about a first-time buyer mortgage and buying a property and all that kind of stuff. Answer questions. Now, that's not happening very often to the whole population, because they've got systems, of course, where they could do this webinar for thousands of people. You brokers are doing this kind of stuff. I know you are. I encourage you to do it. Talk to your customers about things, educate them. But the lenders are doing it direct now because they can and they will leave you out. And that's the point here, you see, because if you're just doing first-time buyer events, you shouldn't because the Nationwide are doing it. And I don't know, you're great, but they're probably better. They've probably got better technical capability, etc. So don't compete against them. I've seen first-time buyer type brokers competing against lenders direct. Lenders are going straight to the consumers again now. They've done that for a while. They're going straight to the consumer. They do hope that the Nationwide have their own. They do have another site which I'll share with you as well, which is quite an interesting one, isn't it? Let's just change the view here so we can go to that. They've got a this site here, which I've just changed over for you. This is the intermediaries site. So this website is for professional intermediaries only. That's you. They do have the Helping Hand mortgage here available to you. There's a few little caveats as well. Obviously, 95% mortgages, maximum loan size. They're pretty much mirroring the lending they're giving their consumers, and you can obviously use it yourself with the affordability calculator. They've yet to update their portal system to allow you to send them through. It's not available on the MTE, which is the broker portal. All brokers need a portal. You go through lenders. That's how you submit your applications. And they're a little bit stricter on maximum loan to values, etc., etc. But they're doing it for you. But I think this is almost like a knee-jerk reaction, really. They'd love to do it for their own consumers direct, because that's how they want to move forward. And they'll go through on an app on a phone, so the first-time buyers can apply for it on their app, and then Artie will start talking to them, and that's the game changer. You need to work out for that if you're a broker. That's the way it's going. And I predict stuff because I can see what's going on in the future. I'm not a Gypsy Rosie Lee or anything, but I know you look at the hard trends. That's all you do. You just monitor the hard trends, and then you see how they carry on, because hard trends do, and then you can see how the mortgage market's going to be changed. So that's an interesting update there for you on that one. And good luck to my two boys buying a property. Great. Okay, let's change the topic a little bit, shall we? Let's get into another topic that is going to interest you, I think. And that's back into the CMAT 1 syllabus. For those of you doing your CMAT exam, you might be interested in this next topic. So let's just change the view here for you. Again, if you're on the podcast, you can't see this, but it don't really matter because we're now on to the whiteboard. What I'd like to talk to you about for a couple of minutes is passive funds. We're talking about investing money. So we're talking about CMAT 1 here. It's not really mortgage brokers world, but this is a financial advisor, wealth managers world at CMAT 1 level. So don't go into too much detail. Now I want to talk about ETFs, which not a lot of people seem to talk about very much, which is odd really. ETF stands for Exchange Traded Funds. So I'll put the proper title out there for you. Exchange, there you go, Traded Funds. You may have heard of them. Only a little bit in the CMAT book on them, but it's in syllabus, so you should know about these sort of things. And besides, it's jolly useful information to know about. So, as you know, when you're investing money, or you're investing your client's money, or you've got a large amount of money to invest. I'm not talking about 50 quid towards your holiday. I'm talking about thousands of pounds. So you're investing money. There's two ways to invest money. There's to invest money on an active basis. Let's put that over here for you. Active. So if you invest money on an active basis, that's your fund there. Or the other way of doing it, of course, is to do it on a passive basis. We've talked about this before. Passive. Now, the difference between the two, well, there's a number of differences, really. First of all, an active fund over here is a fund that is managed by people who actively manage it for you. They try and beat the stock markets. They try and beat the indexes. They often used to be called stock pickers. They pick the right stocks. And you get your Neil Woodfords of the world, although he's not so good anymore. People who become like stars or queens, princes of the fund management world. They try and beat the exchanges. They do it, therefore, the stock market, there's a picture of the stock market for you. They're trying to get really good growth and a bit of a fall there, but they're trying to really beat the stock market. Whereas passive is purely where the fund mirrors an index. It only intends to meet the growth of the FTSE 100, for example, or the FTSE 250, or the NASDAQ, or whatever it is. They just literally keep to the stock market and how the stock market is doing. So you've got a similar thing going on there, but not so much of volatility, really. It goes up and it goes down with the stock market. Now, the best thing is, though, of course, is charges and fees are high on active, and the charges, there you go, on the passive are very low because there's no humans involved here. It's just computers tracking an index. But over here, there's humans. So that's a big thing because I got my statement through from my SIP provider at the weekend. I won't tell you, it doesn't matter. And I got a couple of quid in there for my SIP, for my pension. And it's actively managed by some dudes who charge a blooming fortune for it. There's all sorts of charges coming out of it. There's like a monthly advisor fee, an annual advisor fee, there's broker fees, there's charging fees. I'm actually spending more in fees than the thing's making money now. And I'm thinking, hold on, what's going on here? And a lot of people are thinking the same thing because a passive fund has very low charges. Although this might beat the stock market, not always, of course, this one won't. The charging structure is much, much lower. So let's get into ETFs then, because over here in the active fund world, we've talked about investment trusts. They're the big ones, aren't they? Investment trusts, REITs, of course, real estate investment trusts, OICs, open-ended investment companies. These are all active, mostly. There are some exceptions. They're mostly actively managed. But over on the right-hand side, ETFs, or exchange traded funds, ETFs, are the most important passive investment fund. Now, what the ETF does is it tracks a range of indices or sectors. So it tracks a range of these things. So I call them indexes or indices, which is the plural. So the FTSE 100, the FTSE 250, the S&P, the DAX, whatever indexes or sectors, technology, energy, whatever. It can track thousands of different sectors, and you choose which index or sector you want to track. It's as simple as that, and then the computer system sets itself up to do so. They're very diversified, as you can probably appreciate. You can get ETFs investing in thousands of different shares effectively. So they're a great investment, but they just track an index. That's all. They're just passive. FTSE, we used to call them tracker funds, didn't we? There's another name for them, and that's the ETF themselves. How do they work? Well, they are open-ended. The difference in open and closed. Just a different color pen here for you, so we can see the difference here. Closed fund, for example, over here, investment trusts are closed, aren't they? In other words, once it's bought, it can't expand the fund. OICs are open. In other words, they can expand and contract. ETFs are open as well. So that's open versus closed. The thing about ETFs is most of them are are physical investments. In other words, they invest in the shares of the index, but you can have what they call synthetic ETFs, which don't invest in the actual shares. They kind of mirror the performance of the index, and they get the returns by buying swaps from investment houses traditionally, who provide an income according to how that index would have performed. So they don't actually invest in the shares, they actually just mirror the share index and get a return accordingly. Or you can have a physical ETF which actually physically invests in the shares of that index, and you obviously own a proportion of that one. They are traded, of course, traded on the stock market. It's why they're called exchange traded funds. That's a good name for them as well, isn't it, at the end of the day? The other thing, to get a bit more detail really, is if you think about it, an investment trust which is active, or you've got an ETF which is passive, not dissimilar. Obviously, one's closed, one's open. Now, an investment trust may well trade above its net asset value, as they often call it. A net asset value, a NAV, let's put that up for you in black. Let's put that over here. A net asset value, the NAV. You might have read about that in the book. That basically means what the thing's worth. So if you added up all the shares that are in the fund, so if you added up all the shares in the investment trust, or you added up all the shares in the physical ETF, it will be worth X amount of millions of pounds. That's the net asset value. Now, the ETF itself trades at roughly the same value as the NAV. Although it's traded on the stock market, it trades at the same value. It does that because demand for these things isn't high. If you wanted to sell it, it's very difficult to sell it. Demand is not high, the ETF. So it trades at the NAV. Whereas the investment trust often trades above the NAV because demand for investment trusts are much higher. Second-hand demand, that is. So that's something to think about as well. That's pretty much about it, really, when it comes to an ETF. It's something to think about. But I think I brought that topic in for you into boot camp here because I wanted you to appreciate the difference between active and passive in a couple of examples. ETFs, who do you buy them from? Well, loads of people, massive competition for these things. You've got popular ones like Vanguard, you've got Fidelity, BlackRock. These are huge investment houses. They have ETFs on all sorts of indexes. And very easy to buy, very low cost to buy, very low cost to manage. So it tends to be the way that these companies are moving forward so they can sell direct to consumers, trying to bypass investment managers and wealth managers who tend to get involved over here, because that's where the charges are much, much higher. So if you're happy just to track an index and you don't want to pay too much charges, then that's where you need to go. And I may well switch my SIP over to that and get it much more into a passive investment as opposed to active. Well, it does do quite well, actually. Although recently it has plunged a bit. So we need to take a look at that for you. Just an update for you. Hope that's been useful. Bye. There you go. Hope that you've enjoyed that as a bit of an update for you. For those of you listening to the live stream, with an update there for you on ETFs and all those good things. Writing tonight about stagflation. So do get onto our database to get these weekly updates which we send out. We send them out Monday at 6 o'clock. They're usually writings and updates and things. And you can get those. It's also on the blog, which is advisorcpd.com, which is a jolly useful thing for you to have a look at as well. Hope you have a good week. Yeah, let's hope that the weather continues as it is. It's lovely out there, isn't it? Really spring-like, which is very enjoyable. The days are longer as well, which makes life easier. Remember those first-time buyers are coming out looking for these houses? I just hope a few more vendors put their houses on the market in order to get them sold, and that way we can have a really robust Easter period for buying and selling properties as well, and that'd be great for the mortgage market. Interest rates, of course, went up last week. You probably read about that, but you knew about that. You don't need anybody, you don't need me to tell you that they went up, do you? Starting to trickle upwards. Not a big problem really. We've got high inflation as opposed to low inflation. Stagflation starting to cripple in now because we've got energy issues with and wheat and various exports that Russia and Ukraine would have done, because therefore the supply has been constricted. Prices are going up. So we've got a situation where we're having rising prices, and possibly that might cause a recession. But we'll write about that in the update tonight. Other than that, I hope you have a great week. Good to see you again, or hear from you again, or whatever it is. And I'll see you next week. Bye for now.